Now let's talk about the American economy. The U.S. Federal Reserve has made a move. That's the American Central Bank. They call it the Fed. They have a new mission on their hands: how to avoid a recession in the U.S. After months of holding steady, the Fed has cut interest rates.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point.
It's a 0.25% cut that brings the interest rate between 4 and 4.25%. It is called the benchmark rate. It's the rate at which banks borrow from each other, but it affects all kinds of debt. From credit cards to home loans, it touches everything. And this is the first rate cut since December 2024, since December last year. The Fed chief says more cuts may follow. There could be 2 more reductions before the end of this year. The Fed chief is a man called Jerome Powell. Over the last few months, he has been under tremendous pressure from the White House. President Trump has been attacking him personally. He says Powell has been slow to cut rates.
I think he's done a bad job, but he's going to be out pretty soon anyway. In eight months, he'll be out. But I call him too late. He's too late all the time. He should have lowered interest rates many times.
So Trump has finally got his wish. But the Fed insists that it's not politics that has driven these rate cuts. It is hard data. The Fed was being cautious before, but now it is concerned. And one of its main worries is the job market, the U.S. labor market. It is weakening. Unemployment has touched 4.3%. That's a 4-year high.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up.
Long-term unemployment is rising. More than 1.9 million Americans have been jobless for 6 months or more. 1.9 million, that's over 25% of all unemployed people in the U.S. Plus, jobless claims are also up. These are people seeking unemployment benefits. Their numbers have gone up, and this shows that more people are being laid off. And to make matters worse, America is creating fewer new jobs. Look at the jobs added in the last financial year, 911,000 less than the year before. And all of this is making workers lose confidence. We have the findings of a new survey. It says only 45% Americans believe that they will find a new job if they are laid off. These numbers have sparked concerns at the Federal Reserve, and that is why they're cutting rates. So how does a rate cut help? A rate cut makes borrowing cheaper. Since interest rates are lower, your EMI is lower, so more businesses get loans. It also makes home loans and credit card debt less expensive, and this gives consumers more confidence to spend. And when the spending goes up, it fires up economic activity. It supports job creation. It boosts growth. Basically, this is how the Fed can avert a recession. But cutting rates is not a risk-free strategy. It also has a flip side. If interest rates fall too quickly, it can fuel inflation. Prices tend to go up because people are spending and the demand has increased. So that's the challenge for the Fed. It has to balance 2 goals. It has to keep inflation under control and it has to keep prices stable. At the same time, it has to ensure that there's enough money flowing in the economy so that more jobs can be created. Now, this is a tricky balance. A tough one to strike. These 2 goals are pulling the Fed in different directions. Inflation was close to 3% in the month of August in the US. And that's high for America, 3% inflation. The Fed's target is 2%. So 3% is a problem.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
Prices are already high and Trump's tariffs are making the situation worse. Import duties on everyday items are up. This has made clothes expensive and this has caused grocery bills to rise. Tariffs have increased prices by almost 2%. That's according to a report by Yale. So the Fed here is walking a tightrope. If they cut interest rates too fast, inflation could spike further. If they move too slowly, the economy could slip into recession. So what will they do? What is their game plan? Well, Jerome Powell says they will go, and I'm quoting, meeting by meeting, meaning the Fed will keep tracking the data and they will decide on a case-by-case basis. It's a cautious approach. The goal is what economists call a soft landing. What's a soft landing? It means the Fed wants to slow down the economy just about enough to bring inflation down without raising recession risks. Or as Jerome Powell put it, this is, and I'm quoting again, this is a risk management cut. It's not a panic move, just a recalibration for now. But can they pull off a soft landing? Or is it already too late for the US? The next few months could decide the fate of America's economy.
Firstpost now available in 9 languages on YouTube. English,
Stands at $36 trillion.
French,
Le FMI, comme
German,
Geschäftsführenden Direktor,
Hindi,
$30 trillion ka-charge mo.
Indonesian,
Pemerintah tanpa pemeriksaan.
Italian,
Skali radikali.
Japanese,
4 兆ドル以上も
Portuguese,
por causa do próprio balanço patrimonial.
Spanish.
Beautiful bill.
Go to Settings, click on Audio Track and select a language of your choice. Be the first to know what's happening around you in your first language. Firstpost.